Okay, so it seems like we're back here again. It's been about a week and we still seem to be having a problem with the coronavirus, and I don't know when we're going to be back together again. I'm looking forward to that time, obviously. I've had a little bit of information back from you. I've had some questions, and this is good. I really like the idea of students writing back and forth questions, and I try to answer them, and sometimes I try to answer them on the video right here. But the bottom line is that we need to get through this material because the Cambridge exams are going to take place whether we have a coronavirus or not. And clearly you and your parents want you to do well, and your teachers are here to try as best they can to try to overcome a lot of the problems that we are facing with this natural disaster. It's not just here in Vietnam, obviously. It's really, really big in Italy and in Iran, and obviously in China as well. In fact, compared to most countries, Vietnam is doing really, really well. And so the schools aren't willing to take any risks with your health, nor with my health. And so that's a good sign that they care about us and that they love us a lot. So really what we need to do is just get on with the work and try our best. And hopefully, by me working with you every day, if necessary, coming up to the exam, we will survive. We will overcome, as they say. So what we're going to do is we're going to try to finish this chapter 4. The final sort of topic really is about exchange rates. Today, which is the Thursday, the 12th, I think it is, the 12th of March, I sent to you all a handout about exchange rates. We've talked about exchange rates in the other lessons as well. In general, we talked about when we're doing a little bit of a review of chapter 4, I talked a little bit about exchange rates, but I never really got into it in a big way. You can see here, this is the handout that you should have with those people holding up different types of money. And this is the handout that you should have. You should have your book open, your course book, your economics course book open to chapter 4, the macroeconomy, and you should have the exchange rates handout. And if you notice that at the end of the handout, you have 3 questions to send to me, okay? And I really need these answers, these 3 answers by this weekend, really, because we don't want to start lagging behind where I have to check to see if in fact you have finished previous pieces of homework. I have taken note of your homework, and I have sent to your coordinator those students who have finished and who have not finished their homework. I'll be really honest that it's now about a half of your class, grade 10, that have completed the homework, and I'm happy about that. And some of you have done really some fantastic work, like Voodoo Lynn in particular. She really has hustled, and she made sure that all the work was done and to a very high level. And I expect that from all of you. I think that you're a good class in general, and I'm proud of you. But clearly there's I think there's 21 students in the class. That makes, you don't need to be a rocket scientist to work it out, but there's about 12 of you who are not doing the homework, and 9 of you who are doing the homework. So I don't know about you, Van An, but for me, I'm not totally satisfied with that type of statistics, and I'm going to again keep your coordinators informed as to your progress, and they will be sending your parents notices if you continue to refuse to complete your homework. They're not difficult. This one is only 3 questions, okay? 3 pretty easy questions. Certainly if you have the handout, you should have the handout, because on the Google Classroom, the handout has been uploaded so that you all have a copy of this handout. So there is no excuse. Okay, so let's start the class, and we're dealing with exchange rates. As we all know, different countries use different types of money or currency. In the UK, goods and services are bought and sold with pounds sterling, while in Vietnam it is dong, and the Americans use the American dollar. Okay, and I gave you a definition. The rate at which one currency can be bought and sold into another currency is known as the exchange rate. And you can see very clearly there is constant fluctuations from this graph here. You can see constant fluctuations of the different currencies. And this actually is going on 24/7. The value of currencies are going up and down. You could easily ask the question, why are they going up and down? And as I said to you before in class, that usually it's got a lot to do with supply and demand of those currencies. If the supply goes up, then the value will go down, and if the demand goes up, then usually the value of the currency in relation to another currency will actually go up. Now, in terms of Vietnam, there's a number of factors, most of which relate to international foreign companies. We call them multinational corporations, who are playing a major role now in the Vietnamese economy. And these companies are basically trying to change their money that they make from selling products in Vietnam dong every month, and they go to the bank and they want that money to be changed into US dollars. And they have already made that agreement with the government to make sure that they can exchange currency into US dollars. And for that reason, you will notice that the exchange rate tends to dip a little bit. It will go down. In other words, the dong, which is about 23 to 1, I think at the moment, if it went up to 24.5 on the final day of the month, that's quite believable. But by about the 4th or 5th, suddenly it's gone back again, lending it to the accusation that there's a little bit of currency manipulation going on here, where the government is trying, probably quite correctly, to stabilize the currency in order to maintain a certain amount of confidence by businesses and labor, to make sure that internationally that there is no run on the currency. In other words, people are not trying to get rid of their Vietnam dong, and that the Vietnam dong is a good reflection of the country's economy. It's one of those things that is often given as a reflection as to how well Vietnam is doing, and therefore, patriots who believe that, they believe in Vietnam and they want Vietnam to succeed, like myself, we're actually quite pleased when we see the stability and the strength of the Vietnam dong, because the alternative is a total disaster. I think I've said to you before that I've lived in countries where the currency was going up and down all the time, usually down, and countries like Zimbabwe, which had over 1,000,000% devaluation, due mostly because of inflation. Also, I lived in a country called Nicaragua during the 1980s when there was a war going on, and you'll find that when there is a war, that there tends to be a lot of instability in the currency, and the government really tries to fix the exchange rate as a means of keeping the country a little bit stable, even though they're having a war. So if you sort of turn the page here, you can see a little bit about the effect of an increase in the exchange rate, and you can see this is how you would draw the graph. It's a fairly simple graph with the exchange rate on the y-axis and the quantity of the money that you're actually giving would be the x-axis. And this might be, for example, the dollar to the dong, for example, and that would actually help you to sort of read visually into what is actually happening with the exchange rate and consequently the economy as a whole. Now, what you would probably find on the exam is that there would be questions about the consequences to the economy of an unstable, or what we call a volatile, exchange rate. And that would definitely be a question that should be answered in a 4-paragraph manner, where you basically explain what a volatile exchange rate is, and then you basically tell us why it is so important to have a stable exchange rate. And then on the other hand, on the 3rd paragraph, you could say, well, on the other hand, a floating exchange rate, where you allow the exchange rates to float to whatever the value of the supply and demand leads it to, that this is actually better because this shows the true value of a currency without any government manipulation. And for that reason, international investors will value your currency almost like a hard currency, where they would be willing to accept your currency in payment for, let's say, oil imports, etc., etc. Okay, and in this handout, you have the different alternatives. The first one is the floating exchange rate. The floating exchange rate, which is probably the easiest exchange rate to understand, because it's a normal supply and demand graph, and it's floating depending on supply and demand, is probably the most risky. Okay, it's the most risky. But it also has the positive consequence of creating the conditions where the value of your currency is the true value of your currency. And that means that foreigners would accept your currency in payment. And that's not the case for most countries in the world, I'll be honest with you. In fact, many of the countries that I have worked in, they don't have an exchange rate that is a hard exchange rate. I used to live in Bangladesh for 5 years. There's definitely no value of a taka, a Bangladeshi taka, outside of Bangladesh. Or just before I came to Hanoi, I was living in Cairo in Egypt, and there you have the Egyptian pound that had suffered when I was there, has suffered a huge depreciation in the currency, and this was due to government policy, where they somehow decided that because of the economic crisis that they needed to create some form of stimulus where a lot of foreigners would be willing to invest in the Egyptian economy, because everything in Egypt became very, very cheap. Now, that was really good for someone like me who was paid in US dollars, because it meant that everything you bought, whether it was a hamburger at McDonald's or a table at a furniture shop or anything you wanted to buy, would definitely, as long as it was made in Egypt, would definitely be inexpensive. But anything, of course, that would be imported would be unbelievably expensive. So for that reason, it is a highly risky thing to float the exchange rate and to depreciate it with the intention of stimulating the economy. The next one, if you can see on your handout, page 3, we're talking about the fixed exchange rate. Okay, and this happens quite often when you have a command economy, when the Soviet Union existed, and when China had a centrally planned economy, they usually fixed the exchange rate. I think North Korea still do. They certainly would never allow foreigners to manipulate the exchange rate for maybe foreign interest to destabilize your economy. Maybe these are enemies of your country and they do not want you to succeed, and therefore they will try to to destabilize it. And therefore what does the government do? The government suddenly decides to set up a law saying, okay, Monday morning we're going to have a law that says that the Vietnam dong is equal to $1. And everybody goes, wow, I'm rich now. Anybody who has a million dong, which isn't that difficult, okay, would suddenly, in theory, become a dollar millionaire. And so we would all be celebrating in the streets. But of course, what's going to happen is the banks would suddenly close their doors. They would refuse to accept the Vietnam dong as a payment to buy dollars because it had been artificially revalued, not devalued, but revalued. The dong had been pushed up to a one-to-one par level, we call that. And the banks would just not accept it, okay? They're not in the business of handing, value to people for nothing. And for that reason, they would just say, oh, okay, if the government wants to do that, we're going to close our doors, okay? And there would be no banking services until the government changed their laws. Now, the government could say, okay, well, we are going to nationalize some of the banks or all of the banks, and we are going to be the ones to decide who to give the money to or not. Well, the problem with that is that the ordinary people will probably never get, dollars when they want to hold dollars, or they want to go on holiday, or they want to do whatever. And you'd have to make an application, and you'd have to sort of say, well, the reason why I need these dollars is for such and such a reason, and you got to do it in triplicate, and somebody's got to stamp the paper 14 times. And then maybe they're going to say, no, I'm sorry, we're not going to give you the dollars because we don't consider you to be that much of a priority. Okay, well, that's pretty hurtful to you because you consider yourself to be a priority, but they're not going to do it. So somehow, as a compromise, the government decides, well, we better change this and make it a little bit more flexible. So what they do is they have a number of alternatives. The most common one is what they call the managed float, which is at the bottom of, I think, your page 3, and the adjustable peg system. And both of them really are related to the idea that you're going to try to adjust the value of your currency within a certain limit, okay? So in other words, you might have a 5% bar where you will not allow the currency to go either up or down by more than 5% over a period of maybe, let's say, 1 week, okay? Well, that sounds like a really good idea where you're trying to compromise, where you're allowing it to slide, you're allowing the currency to devalue, but just not quickly, okay? Which I think is probably the case in most countries, okay? Even in Canada, if we allow the Canadian dollar to slide, we actually allow it to slide relatively slowly. Now, I can say that fairly smugly, but I know for a fact that the Canadian dollar 4 years ago, when I came to Ho Chi Minh for the very first time, was 1-to-1 in 2016. Canadians felt quite rich, 1-to-1 to the US dollar. And over a period of 4 to 5 years, we have slowly discovered that our currency isn't worth 1-to-1. And now it's about, if you look at the newspaper, it's about 76 cents to the US dollar, which basically means that it's gone down by about 25% over a period of 5 years. So it may have gone down slowly, but it still went down pretty dramatically. And so, it depends on what sort of business you're in. Canadian exporters are obviously doing kind of well, foreigners will come to Canada because the holidays are cheap in Canada and it's a lot cheaper. Everything seems to be cheaper in Canada than in the US. And for that reason, we're benefiting from a low dollar. But of course, Canadians are not self-sufficient. We are not a country that, only produces everything for ourselves. And therefore, we need to import products too. And all those imported products are now incredibly expensive. So there's a trade-off. There's a trade-off which we have to live with in Canada. And most Canadians, I expect, they somehow, they don't like it because, Canadians feel a little bit, discouraged, or they feel humiliated a little bit, the fact that our dollar isn't as valuable as we would like it to be. But the bottom line is that our economy is more, dynamic and more successful at the moment than when it was at a par of 1-to-1. Let's turn the page and we can see the next one is just explaining some of the winners and losers of devaluation and depreciation, and how can governments influence the exchange rate in a managed float. Okay, I said to you that this is really not that uncommon. In fact, it's almost like the moral equivalent of the stock exchange, because what happened only a week ago, in fact I think it's about 3 days ago, was because of the coronavirus that the stock market is actually going down quickly, okay? And in English, we call that a bear market, okay? It used to be a bull market, which means that the value of the shares in general are going up. But at the moment, they're basically going down, and we call that a bear market. So a lot of investors are not very happy because they think that they're losing a lot of money. So for that reason, a lot of people are sort of saying, well, what can we do to make it better? And well, what happened was that about 3 days ago, they had a crash where I think that the Dow Jones Index, which is an index of about 30 of the largest companies in the New York Stock Exchange, basically went down dramatically, and it lost about, if I'm not mistaken, it lost about 12% of its value. So it's like $30 billion was just like that wiped off the stock exchange. It's a little bit difficult to conceptualize, to really understand how that happens. But a lot of the value of many of these shares are a little bit sort of artificial. And somehow when people get all jittery and they just start selling their shares, and they're prepared to sell their share at whatever the price they can get for it, all that happens is the value of those shares tumble. And what the New York Stock Exchange did was they pulled out the plug. They pulled out the plug for a couple of hours to get people to calm down, because they felt that people were going crazy, that people, psychologically, where it was like the moral equivalent of jumping out of a window. They saw all the shares going down and they just said, let's sell everything. Well, that is like we call it in English, a self-fulfilling prophecy, where if you try to get rid of everything, things actually get worse rather than get better. So for that reason, they pulled out the plug. And this is what they do in the exchange rates as well. They actually will stop trading in the international currency markets because they feel that people are getting a bit crazy. And they feel that this is not very helpful with the market to try to find the true value of the currencies. And so this is one of the strategies. You could even include that on your exam is, what are you going to do about a currency that is crashing? Well, I mean, you could pull the plug out, of the market, you could say. It's a bit like you're selling chickens and you don't like the price of the chickens, so you pull out the wires of the electricity so that nobody can see anything, so that the chicken selling and buying has to stop for a couple of hours to get people to calm down. On page 4, they have other tricks as well, things like interest rates. The governor of the central bank has the responsibility to set the country's interest rates and therefore could make financial investments in the country more attractive by raising them. Greater demand for the currency and a reduced supply will then raise the value of the currency. Another consequence of raising the interest rates would be to reduce consumption and investment, leading to a drop in the GDP. So this is one of the, the problems that you're going to have. I mean, you're kind of solving the problem on one side, but like raising interest rates sounds really good because what you're doing is you're making investments from overseas to appear to be more attractive. But in actual fact, by doing that, by raising the interest rates, what are you really doing? But you're making borrowing more expensive. And by making borrowing more expensive, it means that people are not going to borrow, and it means that there's going to be less money in circulation, and therefore the economy will start sliding downwards. Okay, there's not really enough consumption. And as I said to you before, that consumption makes up about 70% of the GDP. So if people are not buying, then the economy starts to slide. Another trick that they do are something called currency controls, where central banks can alter the supply and demand of a currency through currency controls. These are limits on the amount of foreign currency that can be bought. A firm wanting to import cars would have to buy the foreign currency from the central bank, while a firm selling local textiles overseas would have to sell any foreign currency it received to the central bank. By limiting the amount of currency available, one is creating a system where there are many different exchange rates. Well, it does solve the problem in some ways, because you're trying to get people to understand the consequences of their actions. And so by the central bank kind of supplying or changing the amount of foreign currency available, it kind of means that they can suddenly decide that they don't really want you to be buying Mercedes-Benzes from Germany anymore, that in their wisdom, they feel that that money should be or could be spent in other ways, and therefore they could create these currency controls to stop you from buying things with scarce supplies of foreign currency for very kind of what they would see as very trivial reasons. Like they might say, why do you really need to have a Mercedes-Benz made in Germany and imported and paid for in foreign currency? And of course you could always say, well, it's because I like the comfy seats, or I like to drive in comfort when I go from Hanoi to Da Nang. But I don't know if the government's going to see it that way. They're just going to say, well, that's not really a priority for us. And so a lot of people don't like that, okay? A lot of people who support the free market might say, well, we should have the right, if we have the money, we should have the right to buy, in Vietnam Dong, we can buy a German Mercedes-Benz and let the government find the foreign currency, because that's what's going to happen. You pay, I don't know how many trillion dong to buy a Mercedes-Benz, and then you go to, the Mercedes-Benz dealer, they take your money and then they go to the bank and they want it changed probably into euros because, the Mercedes-Benz is made in Germany and they want euros. And, the government may have problems finding that type of money, and they may say, well, we don't really have that. Well, businesses won't put up with that. And so they will insist that the government, if you want these companies to remain in your country, they need to have the facility to exchange their currency into foreign exchange at will, without any ifs or buts or excuses. We then have borrowing from the international institutions like the IMF, which I think we've talked about this before. The International Monetary Fund is not a very friendly organization. You can solve many of the exchange rate problems by using the IMF because you feel that you're in debt and that you're trying to get yourself out of debt, which might push the currency up and different arguments here. but it's usually considered as a last resort, for a country wanting to maintain a high exchange rate, which would be to borrow from institutions like the IMF. Now, IMF, they're not going to give it as a gift. They're not your mother. They want the money back with interest. They will lend you the money, but when you tell them, well, I need about 10 years to pay back my debt, ooh, they'll say, no problem, but we're going to start running your Ministry of Finance, okay? They're going to start arriving at 8 o'clock in the morning, and they'll say, okay, we're going to run your economy from now on, because they have no intention in allowing you to sort of frivolously waste your hard currencies, etc., or to allow your currency to crash. They have a lot of money invested in your country, and they want that money back. And they kind of represent a lot of investors around the world who are kind of a little bit edgy as to say, well, we don't know if this country will ever pay us back for all these loans. And so as a strategy to make sure that they do get paid back, that the bottom line is that they'll say, okay, well, we're going to make sure that, we're going to start making a profit in this economy. And they may start doing things that you don't want to happen, such as privatizing, huge parts of the economy. And you may feel that that's not a priority for your government. Or, you may feel that, the IMF may decide that subsidies for bread or for rice are too expensive. And you may say, well, really, our support comes from poor people who cannot afford to buy rice or bread, and therefore we need to subsidize it. Well, the IMF are not that concerned about who your political support comes from, and for that reason that they will be very happy to start cutting away a lot of your programs, your social programs, to make sure that the government not only makes a profit, but basically pays back all their loans. Okay, I mean, it's a bit like if you borrow $10 from your brother, maybe your brother's gonna say, well, he wants you to tie his shoes now, or he wants you to give them a back rub, or they want you to tickle his toes or something like that, because he now feels that you owe them something, you owe him something, or you're a little bit indebted. And the IMF somehow feel the same way. They feel a certain amount of, in English we call it leverage. We have a bit of leverage against the countries, the IMF would say, because now we have lent them a lot of money. We have a little bit of power, so we can start telling them what to do and what not to do, which normally a government would never accept. This type of behavior by a foreign institution, particularly one based in Washington. Can you imagine, what Ho Chi Minh would say if after suffering, the Vietnamese people suffer for how many generations to liberate themselves from foreigners, only to have foreigners arriving in pinstripe suits and ties and arriving and telling the Vietnamese people how to run their economy. I think that he would be very disappointed indeed. So for that reason, the government has decided, as much as they can, to avoid asking the IMF for help and to try to look for other strategies to stabilize their currency. The final one is a kind of a, you might say it's an easy one, because it's easy to either devalue or revalue your exchange rate. Usually, I'd say 95% it is trying to, artificially, you're trying to revalue currencies because you feel that your currency has gone down. Interestingly enough, I think I mentioned this to you before, that the Japanese are the only country to my knowledge that does the reverse. They actually are trying to devalue their currency because, because everybody wants to hold on to the Japanese yen for historical reasons that I don't quite understand myself. a lot of Asian people have confidence in the Japanese yen as a stable currency that will never crash or go down the sink. So it's a bit like the American dollar in the West, that a lot of people hold on to American dollars in their pillows or wherever. And so a lot of Asian people do the same. Well, what that does is that it creates this constant demand for Japanese yen, which a lot of people think is great because they know that, if they need to save money for a long period of time, they prefer to save it in Japanese yen rather than in their domestic currency. But the bottom line is that because of all this demand for Japanese yen, this pushes up the value of the Japanese yen, and suddenly nobody wants to buy a Japanese-made Toyota or anything made in Japan because they're all incredibly expensive. I mean, Japan is essentially an export-driven economy, and for that reason, they need to export their products, and they're not going to do that with a really expensive economy. So this means that the government will just basically come in and they will either buy their currency or they're going to sell their currency, okay, depending on what they're trying to do. Now, I think, I'm not 100% certain, as I've said to you before, but I think that the Vietnamese government does this quite regularly, that they just try to top up their currency to make sure that it remains a fairly stable currency, while the other governments like the Japanese are basically trying to sell their Japanese yen on the open market, hoping that it will go down in value. The reality of life is that there has been a huge amount of Japanese yen that have been wasted by trying to sell off the Japanese yen to push the value of the yen down because it is overvalued. In reality, it hasn't worked, okay? You've had maybe 0.5% of revaluation, or devaluation, I should say, of the Japanese yen. And that's certainly not good enough given the amount of Japanese yen that has been wasted to do that. You could have, spent huge amounts of money on education or roads or healthcare rather than just trying to devalue your currency because you think that your currency is too expensive. Some people might feel that the dong is not expensive enough and may decide to do the reverse. But at the moment, I think that the Vietnamese government is doing a pretty good job because they are able to keep their currency stable. Okay, with all that in mind, we have 3 questions, okay? 3 questions that you need to consider. Okay, the first question is, how are volatile exchange rates damaging to the economy? Okay. That should be an easy question because certainly businesses don't like volatile. They don't like to have unpredictable values of currency because they don't know, therefore, if they're going to make a profit or not. And workers aren't very happy either because they don't know how much money they need to demand from their bosses because, if it's like a 10% devaluation, you may say to yourself, well, I need to have an increase of 10%, because you may feel that your purchasing power has gone down. It's a bit like inflation in some ways, but it's not quite. But they'll do it anyway. A lot of people feel that they want a stable exchange rate. They desire it. So of the 3 systems available, the fixed exchange rate, the floating exchange rate, or the dirty float, which one in your opinion is the most desirable for the Vietnam dong and why? That's a good question, okay? So think about them, okay? Again, 4-paragraph answer. And think about the different types of exchange rates and tell me what you think we should do in Vietnam. And finally, evaluate the alternative options available to policymakers for influencing the exchange rate during a period of managed exchange rate system, okay? So in other words, if we had like a managed exchange rate, okay, so that means that we're we're kind of allowing the exchange rate to float, but we've got our hands in the pie all the time. What exactly are our alternatives? What could we do? Maybe name 3 of them, okay? Tell me, what could the government do if they were trying to create this type of, stable managed exchange rate system? We've talked about that today. It's in the paper here. It's in the textbook. It should be pretty easy. Okay, so we're going to finish there. I think that's enough for today. You're probably all exhausted. So this is the final unit for Unit 4. Probably the most difficult of all the units in the AS syllabus. And so we're going to be moving on. We normally, if I see you again, we will have, let's say, 1 class of a review, and then 1 class of having the test, and then maybe 1 class of going over the answers and finding out where we went wrong. Other than that, we will be going on to Unit 5 when we complete this section, and hopefully this coronavirus problem will have come to an end. So bye-bye and see you next week. Bye-bye.